Hello everybody, welcome to another episode of Erickson TV. Curtis here with Lauren. Hey Lauren.
Hey everybody.
Hey Lauren, I thought we would continue on with our investor coaching series and talk a little bit about some memory, short-term and long-term memory.
Right.
It's interesting from a short-term memory point of view. We've had actually a good rally in the stock market for the last, actually probably going on for about the last 5 months.
Right.
So now people maybe are just now thinking about dipping their toe back in the market, but I thought you had an interesting perspective from people's memories of what's happened in the past with stock market risk and also interest rate risk.
Right. Yeah, this is something that I woke up to a little while ago because sometimes somebody like me who studies a lot of financial history, some things are just so obvious to me that I don't always think about how for somebody who doesn't study financial history, it's not just sort of, the most blatant thing in the world.
Right.
And one thing that's obvious to me is that bonds since 1982 have had great returns. And right now bonds have incredibly low yields. And it's because of the same thing. In 1982 we had very high inflation still, and we had very high interest rates. Interest rates have been declining for 30 years. And inflation has declined too.
So for people that don't understand finance, when interest rates go down, how does that impact the bond price?
Yeah, exactly. That's. I think that's one of the things that is very confusing for a lot of people. So if you have a bond and it has a interest rate of like 5%, and then interest rates go down to 4%, well now everybody wants your bond because the new bonds are only yielding 4%. So as a result, the price of the bond that you hold, the old one with the higher interest rate, the price goes up. In other words, you make money. And the price will go up until, in percentage terms, the yields get normalized. Okay. And they're all kind of like at about the same level, around 4%.
So that's how, like, for instance, even though interest rates have been unbelievably low, from a historical point of view, the actual price of, the actual return on bond funds, for instance, could be much higher.
Yes, exactly. So what people have been experiencing, and they've been experiencing this now for 30 years. For 30 years they've been experiencing great returns on bonds as interest rates decline. They've also, in other forms of fixed income, haven't had to deal with particularly high inflation. Now, and so that means that, if you just got something and it yielded 3% or 4% every single year, hey, you did okay because inflation wasn't too bad. Now, the issue we want to talk about was memory, right? Now, a lot of people do kind of remember that, yeah, in the 70s and early 80s there was a lot of inflation. But the thing is, for most people, especially people who are retiring now or thinking about retiring, that happens kind of earlier in their career.
Right.
It happened when they were sort of starting out, and as a result, okay, sure, there was high inflation, but normally when there's high inflation, wages go up by about the rate of inflation too. I mean, that's what inflation is. Everything's just going up. Prices, wages, everything.
And in fact, during the 70s, and the stock market was going up quite a bit too.
Right, yeah, exactly. So what I was thinking about was, when was the last time that there were really low interest rates? And the last time was really the 1940s. So, for instance, in 1942, that was the worst time you ever could have retired as somebody and put all of your money into bonds or all of your money into fixed income, all your money into safe assets. Why was 1942 the worst year ever? Because there were extremely low interest rates, just like now.
That was basically the end of the Great Depression, in a sense.
Yeah, exactly. And it was the middle of World War II and all sorts of other things. And so the problem is, though, when interest rates go up, for bondholders, the exact opposite things happens as when they go down. Now the prices of the bond you hold, because the interest rate is not very high, the price of the bond keeps going down.
You could lose money in that scenario. People lost money in their bonds.
Yeah, exactly. Yeah. But here's the deal. Somebody who was 65 and retiring in 1942 would be 135 today.
Right.
In other words, they're not still alive. Everybody who actually experienced the worst time period to retire and having all your money in the bond market, they've all passed on now.
Right.
They're not around. That living memory isn't there. And people do have a living memory of inflation, but again, that was a living memory for most people. I mean, maybe there are some much older retirees who had to deal with inflation in the 1970s, but for the most part, people remember inflation as something that happened while they were working, so they remember it as something that happened while their wages were going up while they were working. That doesn't happen if you're retired and if you put all your money in fixed income. But of course, everybody remembers, because we've had two recent examples, they remember stock market risk. So in terms of people's memories, what they've actually experienced, they remember stock market risk, they saw that. they don't remember bond market risk or fixed income risk. And in particular, they don't remember, because they haven't experienced, the real risks of being a retiree and having all of your money in so-called safe assets or fixed income. And this has been difficult for me because, to me, it's just so obvious. But to a lot of people that I talk to, it's not obvious at all why there's any risk at all being a retiree and just putting all of your money in safe assets.
So to end this episode, that probably would be a really good possible explanation of why, even though the stock market has been going solid now since March of 2009, that people still have been leaving equities and going to bonds.
Yes, because who remembers what it was like to be a retiree where you started with low interest rates and then got high inflation?
Right.
Nobody.
Okay. Very good. Thanks, Lauren, for that, and we'll see you next time on Erickson TV.
See you next time.